Hi, my name is Michelle Tiraborelli from Brompton Funds. Brompton is a Canadian investment fund manager with over 25 years of history. In addition to offering ETFs, Brompton's a leading issuer of split share funds. We've created this video to provide an introduction to split share funds. I'll explain how they work, review the key features of the shares, and how they can fit into an investment portfolio. Split share funds invest in portfolios of dividend-paying stocks. What sets them apart from traditional funds is that they issue two different types of shares to investors, which each have different investment characteristics and different return profiles. The Class A shares, which are sometimes referred to as capital shares, have leveraged exposure to the stocks held in the portfolio and are designed to provide enhanced growth potential. Split share funds also pay out some of the capital growth over time to Class A shareholders through cash distributions. And the preferred shares, on the other hand, are like a fixed income security. Preferred shares have a priority claim on receiving their par value back at maturity, which gives them a level of capital protection. The preferred shares don't participate in the growth of the portfolio, but they do receive a steady stream of dividends. This is a simple illustration of how split share funds are structured. For each Class A share issued in a split corp, one preferred share is issued. The proceeds from issuing the shares are then invested in a portfolio of dividend-paying stocks. Split share funds are designed so that the dividend income earned from the portfolio funds the dividends paid to the preferred shares, while the Class A shares benefit from the capital appreciation. Class A shares give you leveraged exposure to the fund's portfolio, along with high distributions, which are very tax efficient, primarily return of capital and capital gains. And these distributions to the Class A shares are funded by capital appreciation, premiums generated by covered call writing on the portfolio, as well as any excess dividend income over and above what's needed to pay the preferred share dividend. Also, the monthly Class A share distribution is usually conditional on the fund having a minimum net asset value. Now, this is an important feature because Class A shares have high distribution rates, sometimes in excess of 10%. This NAV test acts as a safety valve. It's a way to protect capital in the fund in the event of a drawdown in the market by temporarily suspending the distribution. And this allows the NAV to recover more quickly when the markets rebound. And for investors who are only looking for growth and don't need the cash flow, these funds offer a DRIP for the Class A shares to have the distributions automatically reinvested. And split share funds have been around for over 20 years, so this is a structure that's been proven across different market cycles. Here we're showing the annualized total returns for the Class A shares of Brompton's oldest split share funds compared to their benchmark indices. And this performance for the Class A shares is based on net asset value. So this is total return net of fees and expenses. And these shares are designed to deliver enhanced returns, and they've consistently outperformed their benchmarks over the trailing periods shown here, as you can see. Now, of course, Class A shares will be more volatile compared to their underlying holdings. This is simply because they're leveraged investments, but this also comes with greater long-term return potential. This is another way of looking at the long-term performance, comparing the same Class A shares that we were showing on the previous slide, but this time showing the cumulative growth of $10,000 over 10 years. Many of the underlying stocks held in split share funds are well-known, large cap companies that are commonly held by investors. For example, Canadian bank stocks. Class A shares offer the potential for higher returns and higher tax efficient cash flow from those same high quality investments. In addition to having a focus on high quality large cap stocks, split share funds have certain structural features that make them resilient. One is the capital protection mechanism, which I mentioned earlier. This is where the Class A share distribution is shut off when the NAV drops below a certain level. The advantage of this feature is that it keeps capital invested at low points in the market, allowing the NAV to recover more quickly when the market recovers, as I mentioned before. Now, the other important feature of split share funds is that they have structural leverage provided by the fund's preferred shares. This provides advantage over other funds that may use financial leverage like bank borrowing to achieve a certain targeted leverage level. And this because leverage in a split share fund is structural, so split share funds are not forced to sell stocks to deleverage the portfolio when the market declines. And this allows the fund to maintain full upside exposure to benefit from a recovery. So we've been talking about how the Class A shares provide leverage exposure to the fund's portfolio. So we have here an illustration of how capital returns are allocated in a split share fund. So we're again using a simple example, $20 portfolio value with a $10 Class A share and a $10 preferred share. In this scenario, we're saying the portfolio has a 5% gain. So that means there is a $1 gain on the $20 portfolio. Now, this $1 gain goes to the Class A share, and this translates into a 10% return for the Class A share, with the Class A share going from $10 to $11. The preferred share value here doesn't change. It stays at $10, and this is how Class A shares get leveraged exposure to the portfolio. In the opposite scenario, where the portfolio has a decline in value of 5%, the Class A share absorbs this loss. The preferred shares don't participate in the growth of the portfolio, but they do have a level of protection from losses. So it should be clear to see how the preferred shares are a more conservative investment. In addition to capital protection, preferred shares receive steady dividends that are usually fixed for the preferred shares term. Usually the terms are 5 years, and split share funds have maturity dates that set the term for the preferred shares. And normally what happens is ahead of the maturity date, the fund will announce an extension of the term and then sets a new dividend rate for the preferred shares for the next term. And for most split preferreds, including all of Brompton's preferred shares, the dividend rate is reset based on market rates at the time the new rate is announced. So the dividend rate is competitive within the context of the market. And this is different from corporate rate reset preferred shares, which have a fixed spread that the reset rate will be based off of. If that spread's too low, there is risk that the preferred share will trade lower. So this is an advantage that split preferreds have. Another unique feature is that split share preferred shares are redeemable at the holder's option at the end of the term. And this is also a rare feature in the Canadian preferred share market, but quite attractive for investors. These unique features of split shares and preferred shares in particular have contributed to their relatively stable performance. This chart compares the performance of the split preferred share index, which tracks preferred shares issued by Canadian split share funds, compared to the TSX preferred share index, which tracks Canadian corporate preferred shares. So the split preferred share index, which is the blue line, has outperformed the corporate pref index over the long term. We're showing 15-year performance here, and it has done so with less than half the volatility. Investors can choose which share to invest in based on their return objectives and their risk profile. Both the Class A shares and the preferred shares trade separately on the TSX. And the Class A shares are best suited for growth-focused investors seeking enhanced returns and tax-efficient monthly cash flow. If you're bullish on a particular strategy or sector, Class A shares can be used to express that view, but these shares can also be held as long-term investments. And the Class A shares are usually rated medium or high risk by investment dealers. Preferred shares, on the other hand, are suitable for more conservative investors who want stable, tax-efficient income. These preferred shares are typically rated low or medium risk. Several different sectors and themes are covered by split share funds. This is a list of the split share funds offered by Brompton. Dividend Growth Split Corp and Global Dividend Growth Split Corp have more diversified portfolios of dividend stocks, while the other funds have specific sector exposure to energy, financials, or infrastructure. There are now also ETFs available that provide an easy way for investors to invest in split shares. CLSA is one. It invests in a diversified portfolio of Class A shares. This is the only ETF in Canada that offers exposure to split Class A shares. And it focuses on not only on Brompton's preferred shares, but it's diversified across the Canadian split share market for Class A shares. It's actively managed ETF and has a target distribution of 12%. Unlike individual Class A shares, the ETF doesn't have a minimum NAV requirement for the payment of monthly distributions. And SPLT is the preferred share version. This is the largest split preferred ETF in Canada. It's also diversified across the Canadian split share market and actively managed. This ETF has a current distribution rate of 6%. So these ETFs are a great option for investors who are looking to have a diversified portfolio of split shares within a convenient ETF wrapper. Well, that wraps up the presentation. I thank you for watching this video. I hope you found it helpful. If you have any questions about this content or any of the funds mentioned, reach out to our team at Brompton. We're happy to help.